Welcome back to the deep dive. So, today we're tackling a topic that practically defines the economy we live in right now. It's that moment, and I think we've all had it, where you look at something you're doing on the weekend. Maybe it's baking sourdough that is, frankly, way better than what you buy at the store, or you're really getting into trading crypto, or maybe you're just walking dogs for the neighbors. And the thought crosses your mind, I should really be getting paid for this.
Oh, absolutely. The side hustle, it's pretty much the defining feature of the modern workforce, isn't it?
It really is.
Yeah.
I mean, looking at the data in our research stack, they noted that something like 36% of American adults have a side hustle right now.
Wow.
Yeah, that is more than 1 in 3 people trying to turn a passion into a paycheck. And the dream, obviously, is the best of both worlds. You make money doing what you love, and here's the real kicker, you get to write off a bunch of expenses on your taxes.
Right. And that right there is where the dream often runs into a very rigid, very undream-like wall called the tax code. Because while you might see yourself as this budding entrepreneur, the tax authorities, whether that's the IRS here or the CRA in Canada, HMRC in the UK, they might just see you as someone having fun.
Just a hobbyist.
Exactly. And the difference between those two perspectives, it isn't just semantics. It can cost you an absolute fortune.
Which is exactly the mission for this deep dive. We are walking the tightrope today between hobby and business. We've got a massive stack of materials here, from tax court cases to advice from financial institutions and insurance groups. We're going to unpack why getting this distinction wrong is so dangerous, and exactly step by step what you need to do to prove you're the real deal.
And we should probably start with the ugly truth. And I really don't use that word lightly here. The financial stakes have changed drastically in the last decade, specifically regarding what happens when you lose money.
Right, because most businesses lose money when they start. I mean, that's just normal. You buy the equipment, you set up the website, you don't have customers yet, you're in the red.
Correct. If you are a legitimate business in the eyes of the government and you spend more than you make, you have what's called a net operating loss.
Okay.
Generally, you can use that loss to offset other income. So let's say you have a day job paying you an $80,000 salary and your side business loses $10,000. You only pay taxes on $70,000. It's a tax shelter of sorts. The government effectively subsidizes your risk-taking.
Which makes perfect sense. They want to encourage small business growth.
Yeah.
But what if you're just a hobbyist?
If you're a hobbyist, you are in a much worse position. First off, you still have to report every dime of income. There's this pervasive myth that if you make under $400, you don't have to report it. That's for self-employment tax specifically, but technically all income is reportable. If you find $20 on the street, it's income.
Right. The tax man always wants his cut.
Always. But here is the ugly twist. Since the tax laws changed a few years back, specifically for the years 2018 through 2025, you generally cannot deduct expenses generated by a hobby.
Wait, let's just pause there because I really want to make sure you grab onto this if you're listening. So if I spend money to make money, but it gets classified as a hobby, I can't deduct that spending.
Exactly. And the math gets scary very quickly. Let's look at one of the examples from our documentation. It is a perfect illustration of how this goes wrong. Imagine you run an activity, let's say chartering a boat, and you bring in $200,000 in revenue.
That sounds pretty successful.
Sounds great, right? But boats are basically just holes in the water you throw money into. So to get that revenue, you spend $350,000 on fuel, docking, insurance, and maintenance.
Okay, so I've actually lost $150,000 in cold, hard cash. In a normal business world, I'm crying, but at least I have a massive tax deduction to soften the blow against my other income.
If it's a business, yes. But if they classify that as a hobby, you have to report the $200,000 as income and pay taxes on it. And the $350,000 in expenses, ignored, gone.
You're joking.
I wish I was. You essentially lose $150,000 in cash, and you get a massive tax bill for income you didn't even keep.
That feels incredibly punitive. You lose money and pay taxes on the revenue anyway. It's like kicking you while you're down.
It is brutal. And this isn't hypothetical either. There was a specific court case. We reviewed the Gregory case. This couple chartered their yacht. They claimed huge losses to reduce their other income. But the court looked at their operation, saw they didn't really act like they were trying to make a profit. They didn't advertise aggressively. They didn't change their model despite bleeding money. So the court ruled it a hobby.
And the bill.
They owed over $267,000 in additional taxes because the expenses were disallowed, but the income was still fully taxable.
Okay, well, that is enough to scare anyone straight.
Yeah.
So the $1 million question, or maybe the $267,000 question, is how does the government decide? Is there a clear line in the sand where I know I'm safe?
Well, there is a safe harbor rule, which is the closest thing to a clear line. In the U.S., they presume you are a business if you make a profit in 3 out of the last 5 consecutive years.
3 out of 5. Okay, that seems manageable if you're actually trying.
Unless you're into horses.
Why? What's different about horses?
If you're breeding, training, showing, or racing horses, the rule is 2 out of 7 years. It acknowledges that horses are just incredibly expensive, risky, and take a long time to develop. But here is the nuance, and this is what's really fascinating. If you don't meet that safe harbor test, you aren't automatically doomed. The burden of proof just shifts.
Shifts how? What does that mean for me?
If you meet the safe harbor, the government has to prove you aren't a business. They have to do the work. If you fail the safe harbor, say you lose money 4 years in a row, the burden shifts to you. You have to prove your intent was to make a profit, even if you failed miserably at it.
Intent is such a fuzzy word, though. I mean, I can intend to play in the NBA, but that doesn't mean I'm doing it. How do you prove what was inside your head to an auditor?
You don't prove what was in your head. You prove what was in your actions. They use a 9-factor test for profit motive. And our research breaks this down really well. It's not a checklist where you need 5 out of 9 to win. It's a holistic picture. They look at the entire constellation of your behavior.
Let's run through the big ones, because I think this is where people trip up. The first one is the manner of activity.
Right. This is the bedrock. Do you act like a business? Do you have a separate bank account? Do you keep accurate books? If you're mixing your grocery money with your side hustle income in the same personal checking account, you're already losing the argument. A business has rigid boundaries. A hobby is messy.
That seems like low-hanging fruit, but I bet a lot of people miss it entirely.
What about expertise? That was another factor.
This is an interesting one. Do you have the actual skills to make a profit? Or did you hire advisors who do? If you're day trading stocks but you have no background in finance and you're just guessing based on internet forums, they might look at that as gambling or a hobby.
Speaking of stocks, we saw a really similar case in the UK materials we pulled. That one really highlighted this expertise and manner issue.
Yes, the Salt versus Chamberlain case. A research consultant made 200 stock trades. He lost money overall. He tried to claim it was a trade, a business, to write off the losses against his consultant income. The court said no. They looked at it and said, this looks more like a hobby or gambling.
Even with 200 trades. That sounds like a lot of work.
It is work. But the court noted he didn't have the commercial structure of a trader. He wasn't operating with the sophistication or the setup that a professional institution would have. He was just a guy on a computer.
And there was another UK one about property, right? The Campbell case. That one is crucial for anyone listening who is flipping houses or doing real estate on the side. This guy renovated and sold 4 properties in 5 years. He actually made a profit, but the court said it wasn't a trade.
Why not? Flipping houses is like the classic side hustle.
Because he had a full-time job elsewhere, he lived in the properties while fixing them up, and his financing wasn't commercial. It was just standard residential mortgages. So the court basically said, you aren't a developer. You're just a guy fixing up his own homes and selling them. It was taxed as capital gains, not income tax.
It really shows that having a regular day job can actually hurt your argument that your side hustle is a real business.
It definitely can. One of the other 9 factors is financial status. Do you need this money? If you're a wealthy executive and you start a boutique winery that loses millions, they are highly skeptical. They think this is just a tax shelter for your rich lifestyle. But if you're relying on that income to pay your rent, they're much more likely to believe you're trying to make a profit because you literally cannot afford to fail.
What about the fun factor? I think factor number 9 was personal pleasure. Does enjoying the work automatically make it a hobby?
This is the trap. You can enjoy your business. You don't have to be miserable to be an entrepreneur. But if the activity looks like pure recreation, like the yacht example, or breeding golden retrievers, and there's no evidence of doing the hard, boring work to make it profitable, the pleasure factor works heavily against you.
So if you're just sailing around drinking champagne, it's a hobby. If you're scrubbing the deck, dealing with angry customer bookings and marketing to tourists, it might be a business.
Precisely. It's about the grind. They want to see the grind.
Okay, so let's get practical here. Say I'm listening to this, I've got a side hustle, and I'm nervous because I've lost money for 3 years straight. I am failing the safe harbor test. One of our sources mentions a strategy called going dark. What exactly is that?
Going dark is a fear response. It's when a taxpayer realizes they can't pass that 3 out of 5 test, so they just stop deducting the losses. They essentially hide the activity from their tax return entirely to avoid triggering an audit.
And I'm guessing we don't recommend that.
The experts definitively advise against it. The guidance is don't go dark. Instead, double down on legitimacy. If you truly want this to be a business, you shouldn't hide it. You should generate the evidence that proves your intent.
So let's build a checklist for you listening right now. Based on the documentation we reviewed, what are the actionable steps to legitimize a struggling side business today?
Step 1, and this is completely non-negotiable, segregate your funds. Open a dedicated business checking account immediately. Never, ever buy personal groceries with the business card. It sounds simple, but commingling funds is the #1 way to look like an amateur. It pierces the veil between you and the business.
Got it. Separate accounts. What's step 2?
Advertising. There's a great point raised in the research. How many legitimate businesses don't advertise? If you say you're a professional photographer, but you don't have a website, business cards, or any marketing expenses, are you really trying to get customers? Or are you just taking pictures for fun? Keep copies of every flyer and every digital ad receipt. It proves you are actively hunting for revenue.
That makes perfect sense. It proves you're trying to grow. What about education?
Huge. Document your training. If you're taking courses to improve your skills or if you hired a mentor, keep those records. It falls under that expertise factor we discussed earlier. It shows you are trying to learn how to be profitable. A hobbyist just does the thing. A business owner learns how to do the thing better.
In legal structure, does forming an LLC actually help?
It does. Now, it's not a magic bullet. You can still have what the pros call an LLC hobby, but forming an LLC and getting an employer identification number signals that you are taking formal steps to operate as a separate legal entity. It adds a much-needed layer of professionalism.
And the insurance sources brought up a point I hadn't even thought about, which is insurance itself.
Yes. Hobbyists usually don't buy general liability or professional liability insurance. Businesses do. If you're paying for insurance to protect your clients or your inventory, that is a strong badge of trade, to use the UK term. It shows you have real skin in the game.
There's one more technical thing I want to touch on for our Canadian listeners. The research mentioned a specific threshold that sounds like a very hard rule.
Right. In Canada, while they look at the reasonable expectation of profit, there's a hard number to watch, which is $30,000. If your worldwide revenues exceed $30,000, you must register for GST or HST, their sales tax. If you hit that number and don't register, you are in serious trouble regardless of whether you call it a hobby or a business. You are essentially operating underground at that point.
Okay, so we've covered the tax nightmare and the checklist to avoid it, but I want to pivot to something else that came up in the materials, the human element of all this. Just because you can turn your hobby into a business,
Yeah.
should you?
This is the passion trap. We live in a culture that absolutely fetishizes the side hustle. We feel guilty if we aren't monetizing every waking hour of our free time, but there is a real risk of losing the joy.
I've totally seen this happen. Someone loves knitting. It relaxes them after a stressful day at work. They start an online shop because their friends keep telling them to, and suddenly they aren't knitting for fun anymore. They're knitting to meet a shipping deadline, dealing with lost packages, and staying up late worrying about profit margins.
Exactly. When a stress relief activity becomes a stress-inducing obligation, you really have to ask if the money is worth it. The advice is to do a market test before diving in. Don't invest your life savings right away. Try selling at a local fair. See if you actually like the process of selling, not just the process of making. Because 80% of running a business is the selling part.
And there's also the issue of knowing your worth. A lot of these hobby businesses fail because the owner isn't willing to charge real prices.
That is a critical psychological hurdle. If you aren't willing to charge a rate that covers your costs and your labor, you aren't running a business. You are running an expensive charity for your customers. And the tax authorities will see it exactly that way too.
That is a really powerful way to put it, an expensive charity.
It really is. If you consistently undercharge and lose money, they will argue you don't have a profit motive. Real businesses raise prices when they are losing money. A business pivots to survive. A hobby just eats the cost because the payment is the fun you're having.
So let's bring this all together. What is the big takeaway for someone listening who is sitting on the fence right now?
It comes down to 2 words: intent and behavior. The difference between a hobby and a business isn't just the dollar amount in your bank account. It's the intent to make a profit, proven by the behavior of a professional.
And as one of the headlines in our stack put it, don't apologize for making money.
Right. If you want the tax benefits, the write-offs, the deductions, you have to do the boring work, the bookkeeping, the separate accounts, the business plan. You can't have the fun of the hobby and the perks of the business without the discipline of an executive.
It seems fair, in a way. The government effectively says, we will subsidize your risk-taking with tax breaks, but only if you are actually taking a risk to build the economy.
That connects to the bigger picture perfectly. Small businesses are the engine of the economy, so the tax code encourages them. But it doesn't want to subsidize your personal leisure. That's the core distinction.
Before we sign off, leave us with something to think about.
You know, we've spent this whole time talking about how to legitimize a business, but I want to flip it. We are in 2026. Efficiency and monetization are everywhere. Maybe the ultimate luxury today isn't having a side hustle that makes you rich. Maybe the ultimate luxury is having a hobby that costs you money, makes you $0, but keeps you sane.
That is a bold thought. Actually giving yourself permission to lose money for the sake of your own happiness.
Think about the return on investment. Maybe the best ROI isn't financial. It's mental. If you're fighting the IRS to prove your weekend gardening is a business just to save a few $1,000s in taxes, are you winning? Or are you just ruining your garden?
That is a fantastic place to leave it. Sometimes a hobby should just be a hobby.
Precisely.
Thanks for diving deep with us today. Check your records, separate those bank accounts, and we will see you on the next one.